Ladies and gentlemen, good day and welcome to Dilip Buildcon Limited Q4 and FY25 earnings conference call, hosted by Essential Technologies Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Jill Chandrani from Essential Technologies. Thank you, and over to you, ma'am.
Thank you, Manas. Good morning, everyone. Welcome to Dilip Buildcon Q4 and FY25 earnings conference call. From the management, we have with us today Mr. Devendra Jain, Managing Director and CEO, Mr. Rohan Suryavanshi, Head Strategy and Planning, and Mr. Sanjay Kumar Bansal, Chief Financial Officer. Before we begin this call, let me mention the standard disclaimer. The presentation that we have uploaded on the stock exchange, including the interaction in this call, contains or may contain certain forward-looking statements concerning our business prospects and profitability, which are subject to some uncertainties, and the actual results could differ from those. Now, I request the management to take us through the key remarks, after which we can open the floor for question and answer session. I now hand over the call to Mr. Rohan Suryavanshi for his opening remarks. Thank you, and over to you, sir.
Thank you, Jill. Good morning, everyone. On behalf of the entire DBL family, I welcome you all to join us today on this conference call. The results of presentation have been uploaded to the stock exchanges, and I trust you had an opportunity to review them. To begin, let me provide some updates on the broader industry landscape. As you all know, FY24-25 has been a muted year, marked by low ordering activity from most government agencies. This was very surprising to the whole industry, as we'd all expected, since FY24 was a mute year given an election year. We were expecting better, but however, for reasons unknown to us, it hasn't panned out in the way that the industry expected. According to government data, MORPH has constructed 8,330 kilometers of roads, although ordering activity was only 4,874 kilometers up to February 2025. On the execution front, NHAI constructed 5,614 kilometers of national highways in FY25, surpassing their target of 5,150 kilometers. For the next year, the government has set an ambitious target of constructing 10,000 kilometers of highways. It includes the development of 1,100 kilometers in the northeastern states and 750 kilometers in tribal regions. These plans provide us strong visibility for order inflows in the coming year, along with a lot of hope. Our Union Minister, Honorable Shri Nitin Gadkari, recently underscored the vital role of infrastructure development in propelling India's growth. He reaffirmed his ambitious goal of constructing 100 kilometers of highways per day and expressed confidence that India's road infrastructure will surpass that of the United States within the next 2 years. This vision, backed by the government's continued commitment, presents companies like us with significant opportunities to grow and strengthen our order book. In the airport segment, the government has outlined plans to undertake 50 airport development projects over the next 5 years. This includes both the construction of new airports and upgradation of existing ones. All these projects will be executed through public-private partnership model, presenting new opportunities and renewed optimism for infrastructure companies. In the tunnel segment, significant opportunities are also emerging. According to recent reports, 78 new tunnel projects spanning a total length of 285 kilometers and valued at rupees 1.1 lakh crore are set to commence soon. And DBL is a strong player in that segment. At DBL, being a diversified EPC player, we are exploring opportunities in all these segments, including roads and highways, irrigation, water distribution, metro, railways, airports, tunneling, coal mining, and the recently added segment, that is optical fiber laying under the BharatNet project. Overall, we are participating in orders of upwards of 1 lakh crores. We are very confident in the long-term growth prospects of India's infrastructure story. and are fully geared up to capitalize on the opportunities in most of the high-growth sectors. As you can see, the government's focus on the sector is evident through a continuous increase in allocations towards the infrastructure sector. We can anticipate positive developments in the next few quarters. Now, coming specifically to our company's performance, like the industry at large, DBL also witnessed muted order inflows over the past 24 months, with just rupees 2,100 crores of new orders in FY25. This has resulted in a 21% decline in our top line in the quarter on a year-on-year basis, and a 15% full-year basis compared to the previous fiscal on a standalone basis. Our CFO will delve deeper into the details of our financial performance in the subsequent remarks. So while we anticipate robust order inflows in the coming quarters, execution will take time to ramp up and translate into revenues. Assuming some order inflows in the next few months, we expect around 5-7% decline in standalone revenue for this fiscal, with an operating margin of around 10-11%. However, at the same time, we're expecting a 10-15% growth in consolidated revenues. And if you look at even this year's consolidated PAT, that consolidated PAT will continue to grow even furthermore next year. So even in the face of a lot of headwinds on the EPC front, the steps that we had taken in the past along the coal and the road asset business, both of them will keep us in good stead going forward and provide company with predictable cash flows. Now let's talk about our investment portfolio in HAM assets. As previously discussed, we have successfully concluded the Shrem InvIT deal during this financial year. Under this agreement, we have received the full consideration both in cash and in InvIT units. On an opportunity basis, we have sold 1.27 crore units and realized around 136 crores in the last financial year. This is in addition to a cash distribution of rupees 120 crores received from Shrem InvIT during the last financial year. As of March 25, we are holding around 6 crore units, which could generate annual cash distributions ranging from rupees 70 to 80 crores from the Shrem InvIT. Moving on to our InvIT partnership with Alpha, we are progressing in line with our strategic plan. So far, we have transferred a 26% stake in 8 assets out of a total of 18 assets, including in the deal. Among these, 7 assets have achieved COD and 1 asset has achieved pre-COD, and accordingly, annuity payments have commenced, concluding the first tranche of the Alpha deal. The remaining 10 assets are under construction as scheduled and will be divested upon achieving COD. The formation process of our publicly listed InvIT is progressing well. The InvIT has filed draft offer document in March 25, and we are expecting the approvals within this quarter. Now coming to our coal business. Our coal MDO operations are progressing at a rapid pace. In our Siarmal MDO, I am pleased to share that we have exceeded our production target by achieving 18.5 million metric tons in FY 2025 against a target of 15 million metric tons. Please bear in mind, even the 15 million metric tons was a revised target, while our original target was only supposed to be, as per the original agreement, was only supposed to be 7 million metric tons. 10 million metric tons. We are well equipped to exceed our targets for next year as well, and we hope to achieve production volume of about 25 million metric tons as compared to the target of 18 million metric tons. So it is going well ahead of target. In our Pachwara MDO, we have achieved production of 6.9 million metric tons in FY 2025, which is the peak production. This is a 7 million metric ton capacity coal MDO. As per the concession agreement, we will continue to achieve similar numbers for the next 53 years. So that's now kind of stabilized at that level. Lastly, let me touch on our vision for DBL 2.0. I'm proud to report that both our long-term revenue generating business, that is coal MDO, and the HAM portfolio are progressing strongly. These will offer us predictable cash flows, improved return ratios, and a more risk-balanced profile. If I may add, even this year, while we had a depleting order book and revenue depleted, we ensured that our standalone debt remained at the same level. What is also very interesting is that at the DIPL level, at the consolidated level, where CPPIB had also put in capital, we have reduced in FY25 that number by about 200 crores of debt reduced there. Plus, in this year already at the start, till now, we have already reduced another 100 plus crores of. So in total, from last financial to right now where we stand, about 300 plus crores of debt has been reduced at DIPL level. Besides that, let me also add that in this year, we will completely pay off the whole DIPL debt. Besides that, paying off the debt of DIPL, which is in the range of about 400 crores, we will also be reducing standalone debt of in this financial year of about 500 crores. The revenue, like I mentioned in this financial year earlier, will see some hit, but even with that, we will still be reducing our standalone debt. Our EBITDA also, like I said, mentioned, because of a reducing, will be a little on the muted side. But consolidated, if I could talk about even consolidated debt, on a consolidated level, our debt will reduce by more than 2,000 crores. And the revenue will, like I mentioned earlier, will increase at a 10-15%, and the PAT will also increase. So when I keep speaking that we need to now keep looking at DBL, we are looking to make a more lean company. We're looking to make sure that the debt at the standalone level reduces completely, and that exercise is on. Even on the consolidated level, only during the construction time we will be keeping, and the rest, the assets will continue moving year on year. Now, with that, I would like to hand over the call to our CFO, who will provide a detailed overview of our financials. Thank you.
Thank you, Rohanji. Good morning, everyone. I welcome all the stakeholders to our earnings call. Let me present the results for the quarter ended 31st March and year ended 31st March 25. On quarterly performance year-on-year basis, the revenue of standalone revenue decreased by 21% from 2,931 crore to 2,315 crore. The EBITDA also decreased by 41% from 353 crore to 209 crore. The profit after tax is decreased by 62% from 124 crore to 47 crore. On full year basis, FY25 versus FY24, the revenue decreased by 14.55% from 10,537 crore to 9,004 crore in FY25. The EBITDA decreased by 30% from 1,299 crore to rupees 903 crore. The profit after tax decreased by 26% from 422 crore to 311 crore. Now, let me brief about the console performance. So, as Rohanji briefed in his opening remarks, the console performance of DBL is improved within this year. On year-on-year basis, the revenue decreased by 8% from 3,366 crore to 3,096 crore. The EBITDA increased by 100% on year-on-year basis from 330 crore to 661 crore. This is on account of the completed HAM assets and coal business performance. Profit after tax also increased significantly between these quarter 4 FY24 from 3 crore to quarter 4 25 rupees 276 crore. On yearly basis, the consolidated performance, the revenue decreased by around 6% from 12,012 crore to 11,317 crore. The EBITDA increased by 51% YOY basis from 1,422 crore to 2,151 crore. This is on account of good performance by the coal SPVs, coal MDO SPVs and completed HAM projects. The profit after tax also increased 4 times from 201 crore to 840 crore. That is also because of the better performance by the completed HAM and the coal business. This is all on the standalone and consolidated performance of Dilip Buildcon for FY25 and Q4 FY25. Now we can open the floor for the questions and answers. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touch-tone telephone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. I repeat, if you wish to ask a question, you may press star and one. We have our first question from the line of Shravan Shah from Dolat Capital. Please go ahead.
Hi, sir. Thank you for the opportunity. Sir, first, I wanted to understand on the order inflow front. So in the opening remarks, you have mentioned that we are looking at a 1 lakh crore kind of opportunity. So a couple of things to understand. First, if you can help us broadly out. First is how many value of orders we have bidded where outcome is yet to come. Second, out of this 1 lakh odd crore, how much would be from the road? And also, are we looking at the obviously the HAM and the BOT toll also? Yeah.
Thank you, Shravanji. So currently, already that bids have been put in about 10,000-15,000 crores of orders where bids have already been put out, and we're awaiting the opening. In terms of the split between different sectors, that I'm unable to give you, and that's not something that the company anywhere shares. We are, now to answer the second part of your question, yes, we are looking at a mix of HAM, BOT, EPC, all of it, because we also have a large partnership with Alpha, where there is a steady inflow and predictable inflow of equity coming in. So we have various partnerships in place, which will ensure that we have a good return on whatever equity we want to put in for any of these projects. So we are looking at all of these different opportunities across segments and across different model types as well.
Okay. And also in terms of, so now for this year, FY26, total how much more, obviously for last 2 years was noted on order inflow. So now how much order inflow are we looking at? And at the same time, why I'm trying to understand in terms of the HAM and toll, because the actual execution will take much longer time, it is 9 odd months to start once after the awarding. So in terms of the guidance that we are looking at 5 to 7% decline in FY26. So also trying to understand if we are more looking on the BOT toll or a HAM, maybe this could be can have a even slightly more decline, and even FY27 also have some impact.
See, Shravanji, very good question. There are a bunch of points that I think I would like to make out here. See, the bulk of our business is EPC, because the HAM model is only in the road business. Now, road itself has become a small part of our overall order book. So when you look at the company, even if you look at the presentation that is in, almost 80% of the business that the company is doing right now is EPC. So that I think should be able to answer that bit. Now, coming to how the revenue pan out, we have also taken a similar kind of mix when we have given our prediction modeling and told you that, these estimates that we've given you is on the basis of what we expect the orders will flow. We also understand that, like you pointed out, the EPC will start sooner and HAM takes a bit more time to start and show revenue. So it's all been, the numbers that have been given to you according to that. There are a couple of good things that have happened. In the road sector, the government has taken notice of, the challenges that they have faced because of reducing their credentials criteria for bidding of projects. They have really struggled to get projects off the ground and also have started struggling on the construction quality front. So very recently, about a week or so ago, they have changed on the EPC model and made the eligibility criteria more stringent, and similar steps are expected in the HAM model as well. So we are expecting now that the competition should be more moderate. If you look at the last year's data, in HAM, 91% projects were won by non-recognized or the smaller players. 91%. Let that sink in. And in EPC, that number is even higher. So while the government has awarded these projects at record low prices, there is definitely certain question marks on the quality and the project progress that they'll be able to achieve. Hence, they have taken these corrective measures. So we are hoping that flows in line in this financial year. Did I miss out any point?
No, just one thing that for this year, how much are we looking at in terms of the order inflow for full year?
Yes, very right, sorry. So we are looking at about a 20,000 crore order inflow this year. 15 to 20,000 is at least what we're expecting because last 2 years have been quite muted. So we are looking at that and we hope the government will, really push the pedal on the ordering.
Okay. And on the standalone margin, you mentioned 10 to 11% that the margin that now should be the case for even for ongoing FY26 and going forward also.
I'm just speaking about EBIT for FY26 right now, Shravani, because going forward is a very long journey. So, again, once we have more numbers in the end of, now this financial, that would be a better predictability in how the ordering has shaped out and all. Because right now, what all of us, either you or us, would be doing would be just guessing. It would be a pure guesswork. While the bigger numbers that we have tried to give to you are more rooted in certain calculations, which is how much orders we will be able to secure, how many will start, what kind of order profitability we will see in those. So that's been based on some of that. So I think it's better that we should just look at this right now and how the next year after that pans out. We should see that closer to the end of this financial year.
Got it. And now on the debt front, you mentioned that further another 500 crore reduction will be there in FY26. So by FY27, what our stand was, we will be a net debt free. So that remains intact.
Yes, that remains intact. That, like I mentioned earlier during this year as well, that ideology has remained intact. The timing of it may change, differ to external circumstances beyond our control, which is ordering, which has not handled or been. But it's only a timing sort of issue that has happened. It's not a change in our philosophy. It's not a change in the direction that we're taking the company. That is very much there. That we will be a net debt zero company in the next 2 years. And like I mentioned, when you're looking at, because you always look at these things in a great amount of detail, and we've always been appreciative of the larger analyst community which asks us all these questions. So that's why I'm trying to say not only while this year we know that the payments of Jal Jeevan Mission were very, very problem and slow, and almost 9-10 months we didn't see any of that payment coming in, which kept our standalone debt levels elevated. But at the end of it, that those payments realized, we were able to bring that down. But at the same time, we made sure that even our consolidated debt was reducing. So our agenda is very much in line. And like I mentioned, next year standalone debt will be less by 500 crores, and the consolidated debt will be at least 2,000 crores will be reduction in that as well.
Got it. And sir, on the MDO front, is there a way that we will be sharing the profitability number or any value unlocking that are we looking for MDO as such?
Sir, consolidated, we won't be sharing independent numbers. Like I mentioned, this is all the consolidated that you will get. Value unlocking and all is a system, is a function of market demand. If there is any such sort of opportunity where our investors feel that this is in the best interest of the company, then we will take it at an appropriate call, appropriate time. Otherwise, that is how it is. But rest assured, whatever will, if at all some strategy was more to evolve, it will be done keeping the interest of all the stakeholders, especially the minority shareholders, and with all their blessings and guidance.
Okay. Sir, I have 2-3 questions, but if there are more questions, I can come in queue.
We appreciate that. Thank you.
Yeah, thank you.
Thank you. A reminder to all participants, if you wish to ask a question, you may press star and 1. We have our next question from the line of Deepak Parswani from Swan Investments. Please go ahead.
Yeah. Hi. Good morning, team. First of all, congratulations, especially on the debt reduction and MDO performance. So firstly, wanted to check it out, wanted to seek some clarification. If I were to look into the order book, last year at the beginning of the year, we had an order book of 17,400. And this year, at the end of the year, we have 15,000. And revenue has been to the extent of 9,000. So implied order inflow appears to be 6,500, whereas in the presentation, we have reported 2,100. So just wanted to check whether has there been any change in scope of work in the existing order book. That's the reason there is a deviation in overall this thing.
Sir, you're very right. We had last year, because when you look at last year, till then we were not adding the whole MD orders, which should have been rightly done, because that is pure visibility for us. And at the end of last year, that was not being added, but in this financial year, we started adding that. From first quarter, that we started that practice. So which is why that order that you see, even in our presentation, we mentioned that 3 year of whole order, which we have a clear visibility and which is there, that whole MDO is also being added in the order book, which earlier was not. So that was a mistake, error on our part, that revenue which was going to come was not being added to the order book. So it's only that revenue that is being added to the order book right now.
Okay. And secondly, sir, just continuing on the order inflow point of view, like you mentioned about the big pipeline of 1 lakh crore. And just wanted to get your sense. This big pipeline was also there in the month of December, and there was we do understand there has been a delay from the ministry level in terms of awarding. If you can give a broader sense, what is causing this delay at the first place, and whether this problem is getting resolved, and how confident are we? Incrementally, this would flow it out probably in the next 6 to 12 months. The order inflow guidance of 15 to 20,000. That's a part one. Secondly, if you can also give a breakup of this 15 to 20,000, what is the awarding we are expecting from the road sector, and which are the new verticals which will contribute in terms of the order inflow?
Sir, just to answer your first question, the delay in the government ordering is best up to them, but from whatever we have understood till now, because the last 2 years, more than actually that, where the government, where they saw a significant number of new players and smaller players emerging and taking larger share, so they were facing challenges around financial closure of their HAM projects. They were facing challenges around, even once they're getting started, because they've been bid at some really ridiculous numbers, they were seeing challenges in progress. So I think there has been a rethink within the government that this whole process, they don't repeat of the 2009, 10, 11 era, where a lot of players came in and the government got great deals, but none of those deals actually materialized. So I think there has been a rethink in the government that you don't want to have that, because then it's a problem that they will have to again solve, whether it's for banks or whether it will be for the industry. And ultimately, the net loser in that whole scheme is the government. If you have to recapitalize the banks, if you have to solve for projects that are not done, escalated cost of projects. So I think all of that rethinking is happening, precisely where there is an improvement in the qualification criteria that they are doing now. And it's better that these projects are now going to be awarded once that qualification criteria is done. So for us as well, when we're looking at the 15,000-20,000 crores of orders, obviously I can't even an accurate split of how it will pan out in the end of the year, because once you bid for a project, there is always a small probability of what you will end up winning. So we continue to bid across different sectors that we are working in. We're also looking at some new sectors opportunistically. But as and when those things materialize, I think it's a better time to speak about that rather than counting our chickens before they're hatched. So that's the first part of it. Second, you were asking what was that? You wanted to know the exact split. 2018. Hello.
Yeah. And of 15 to 20,000 crores which we are expecting, what is the broader segmental breakup we are looking at out in terms of the overall awarding of this?
The sectors that we've already mentioned in the presentation that we are already working, we should look at that only as a broad breakup. So we are looking at all those sectors. What will eventually materialize, what percentage, those percentages might change a little bit here and there, but that is the segment-wise and even the model-wise, both those splits that we've given in the presentation on page 7, you would be able to make an educated guess around how that should work out. We obviously do not give exact numbers of our bidding strategy, but that's how we should kind of think about it.
Thirdly, just continuing on the order inflow point, we also mentioned there is a 78 new tunnel project worth 1.1 crore, which are also coming at all. If you can also give some broader sense on this in terms of the RFQ criteria for these projects, as well as I think these projects would also require some capex investment to the extent of TBM. So if you can give some broader sense, what is the capex we are looking out for this year, or are we incrementally looking out for buying some TBM machine to bid these projects, or how should we look into all this?
Sir, so the various projects that I mentioned, that is an announcement by the Government of India. This is spread over a period of 5 years. A majority of those projects are under DPR stage, and not all of them will need a TBM. The tunnel that we're also doing, we're doing through boomers, and the project that we will also target will be the ones that use our current equipment only. Now, in terms of capex for the company this year, we are not expecting to do any capex in this financial year per se. So there is some very small replacement capex that we have to do. That will happen. Otherwise, we have no targets of any capex. There is no planned capex this year.
And also continuing on that part, if you can also give a broader sense in terms of the working capital, how should we look into it? And last quarter we had a 100 crore in the Jal Jeevan Mission. It appears to be the relatively better working capital. If you can give us just quantum, what has been the reduction in terms of the data at the current juncture, and whether the execution in payment cycle has normalized in the Jal Jeevan Mission project, and how should we see the opportunities going ahead in this segment?
So the Jal Jeevan Mission payments thankfully have come at the end of the financial year, which provided relief to all the players because they were stuck for a while and had led us for an elevated working capital cycle. Luckily, the overall working capital cycle came down by the end of financial year. We are expecting the next year's working capital cycle to also be in similar range only. We are looking to make improvements, but making improvements is a function of how the government payments happen, how the ordering happens. There are a lot of different factors working on. We're looking to make improvement. It will be in that same in the same ballpark region. I think that should be the headline number there. That will be in that same ballpark region, working capital cycle, which is very much where the industry is at. So while we do that, even with the reducing order book and even with the lower revenue number, the larger bit will be, we will be still reducing the debt. The standalone debt will keep reducing. So the debt equity ratio will improve furthermore.
Okay. And if you can also give the quantum of the data from the Jal Jeevan Mission at the end of this year?
Sorry, what, sir?
If you can give the data outstanding for Jal Jeevan Mission at the end of this year?
Let me just look into it. We can take that offline. It's not, I don't think so.
Sure. And finally, just final question from my end. In terms of the interest expenses with the reduction in the debt, how should we look into interest expenses for FY26?
So basically, for the revenue of 8,500 crore, we are expecting around interest cost around 400 crore.
Okay. Thank you and wish you all the best.
Thank you.
Thank you. A reminder to all participants, if you wish to ask a question, you may press star and one. We have our next question from the line of Prateek Bhandari from Art Ventures. Please go ahead.
Yeah, hi sir, thanks for the opportunity. I wanted to understand about the CR1 coal mine. So what I wanted to understand was once we are done with the coal production and we are able to clock that 50 million metric tons per annum, what are the further plans do we have in place? And what kind of grades of coal are we extracting from there?
So what do you mean by further plans after achieving 50 million metric tons? I'm not sure.
You mentioned about the coal handling plants that should be built.
All right. So the coal handling plant construction will start within the next 2 years. For the next 2 years, it will finish that. We will bring that online so that all that planning for the coal handling plant is going. So that will remove the transportation that we're doing currently via trucks, and it will be done via that.
And what would be the estimated capex for the same?
So the coal handling plant capex is around 850 crore. And it will start constructing, we will start constructing coal handling plant from next quarter, and it will complete in 2 years' time. So before the scheduled completion date.
All right. And what kind of the grades of coal are we extracting from that CR1 coal mine? What is the grade of coal?
G11 grade coal we are extracting.
G11?
Yes.
Is it only the one category of grade, or are we extracting other categories as well?
No. It is G11, the mine is G11. So the same grade coal we are extracting.
All right, sir. Thank you.
Thank you.
Thank you. A reminder to all participants, if you wish to ask a question, you may press star and one. Participants are requested, if they wish to ask a question, you may press star and one on your touchtone phone. We have our next question from the line of Shravan Shah from Dolat Capital. Please go ahead.
Hi, sir. Thank you for the opportunity again. Sir, 2-3 things. First, in terms of the remaining Alpha 10 assets that will be transferring, so it will be this year will be a 7 assets and the next year will be a 3 assets. That's the way one can look at.
Showing the total transfer, the money is 550 crore, and out of that we are expecting 360 crore will receive this year, and it is close to 7 assets we are expecting by March 26% can be transferred.
Okay, got it. And sir has mentioned that 400 crore of DIPL date, so that's the DBL.
Sorry sir, I could not get you.
श्रवण जी आपका आवाज चला गया.
Hello? Hello?
Yes, sir. We
श्रवण जी आप श्रवण जी की आवाज किसी को आ रही है क्या?
no, sir. We can't hear. Shravan, are you there?
You can
So we
take
move on to the next participant. We have our next question from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Sir, my first question is on NHI ordering. So when we expect the pickup in NHI ordering, so which quarter or which, like first half, second half? So how do you think this year will be for NHI ordering?
Sir, we're expecting second quarter onward, it should pick up significantly.
Second quarter. And do you think, any sense on what kind of measures the government is planning or they've already taken in terms of like the smaller players, either in terms of like increasing the qualification criteria, making it more stringent? So what do you think would change this competitive intensity in the mid to the near to midterm?
Parikshit ji, basically, there are two parts. EPC projects, the government has already taken the steps to increase the qualification criteria pre-COVID level. So they have increased the performance guarantee requirement, the technical requirement, and they have increased in terms of the technical and financial criteria. EPC is done. Now they are considering for HAM also. The similar way. So automatically the unrecognized players competition from them will reduce.
Another question is on the diversification beyond the existing segment. So road has been a non-starter for the last 2 years. Nothing much is happening there, and outlook also right now looks a little uncertain given there has been no major awarding from NHI. There has been some state awards. I think we've not been able to get some of these awards from the state. So in absence of these large segment in ordering, so what are the other segments you're looking at to mitigate the impact of slowdown in those awards?
So basically, you can see from our the presentation, slide 7, I believe, the vertical wise and the segment wise order book. We expect orders from all the segments. Though road is reduced, but we'll be getting the new orders from all the segments. We are continuously bidding in all the segments.
So anything on the T&D side or the building segment which can add increments to the new order book?
We are not looking for any building construction.
And on transmission side, anything on transmission battery storage related HAM projects? Anything on that side or solar EPC?
Parikshit ji, we are looking for transmission very closely.
And so renewable side, so the question was what could be the opportunity for us in the renewable, which seems to be a bigger theme now, and how do you want to play that theme? So either both on investment on equity side as well as on the EPC side.
Parikshit, obviously as a company now, given that we have certain capabilities, both in terms of equipment and manpower, we are looking at opportunities across the sector, not just the sector that we are currently doing, but even beyond that. To give you a very specific sort of idea about our strategy going forward would not be possible in that. So those are things that the company needs to keep close to the chest. But we are looking at different sectors, and wherever we find an opportunity that arises at a good pricing, we will definitely be taking that.
Anything being evaluated in international markets?
Yes, so we were evaluating international markets as well. We were evaluating a coal block in Mozambique as well. So yeah, we were evaluating. So we were looking at different opportunities in different areas. So we are looking at different areas.
Okay, sure, sir. Thank you. Sure.
Thank you, Parikshit.
Thank you. We have our next question from the line of Akash Rawal from Buoyant Capital. Please go ahead.
Hello, sir. Thank you for the opportunity.
So I have just one question regarding the coal MDO part. So our execution has been very good on the coal MDO front. So are we looking to bid for other coal MDO projects which are there in the pipeline going forward?
Yes, so we are looking at bidding for more projects. That's a sector that coal now is a sector that we've been involved in since almost 2016. It's been almost a decade that we've been doing the coal sector in some form or the other. While the MDO sector is within the last 4-5 years only that we bid and got into it. But now that we are on track with both these mines, with one being at peak capacity, the other one ramping up very quickly, we are looking at other opportunities.
Okay, sir. Thank you.
Thank you. We have our next question from the line of Sanjay Parikh from Soham Asset Managers. Please go ahead.
Yeah, no, so my questions are answered around the coal MDO, which my colleague asked, the new projects, because there you clearly have done exceptionally well, and so that is answered. One more thing is the micro, is the order book is 36-26 crores of mining, while both the coal projects is 28-26. So the balance, is there an external mining contract you have, and can you have more of them?
So, sir, it is this way. There are two types of work we are doing. The DBL is doing for the subsidiaries. One is EPC work. So, CRML MDO involves EPC work as well. And that CHP, the coal handling plant construction work also be done by DBL. So, the 2,800 crore which is added is basically O&M work, the coal extraction and transportation. Whereas, if you add the EPC work, which is coal handling plant and constructing other infrastructure for CRML, the total order book would be around 3,600 crore, which is shown in the presentation.
Okay, great. It's a very, very clear. The second thing is 14,923 order is executable over what period, and what part of this revenue could come in 26 and what part could come in 27?
So, sir, total revenue this year is planned around 8,500 crore, and for 26 it is very early to estimate, but at the same time, our order book is around 2 to 3 years, and we will be adding new orders. So, 26 will be basically from the existing order book and from the new order book.
But no, just if it is possible that of this 14,923, what is, would it be 7,000, 7,500, which is executable this year? Broadly also will find. Assuming, we surely would win new orders. What I'm saying is, from the current order book, what would be the executable revenue this year and next year, if possible?
Sanjay, that's a very good question. Out of this order book, you can split this into 2 years. So about 7,000 crores of revenue should be able to come from this order book alone.
Okay.
I think that's what you wanted to know.
Yeah.
Yeah.
So very small, what I understand is flow to 28. Largely, this order book will be executed in 2 years. Can we say that?
Largely, this order book is there, so it provides us a very, so from whatever we are targeting, almost 80% of that is like the revenue that we are targeting of, let's say, 8,500 crores. So almost 84% of that will be coming from this order book already. So we have taken a very conservative estimate for new orders and how much we'll be able to start in 22.
Okay, great. Thank you. Thank you very much, and really, in a tough environment, you've done well. Thank you very much.
Thank you, sir. Thank you.
Thank you. We have our next question from the line of Vishal Periwal from Antique Stock Broking. Please go ahead.
Yes, sir. Thanks for the opportunity. Sir, on this profitability for MDO, though you did mention, you're not sharing the numbers, but the numbers which you have shared, say consolidated minus if you do a standalone number, will that be fair to say that the remaining part is coal MDO that is running through in the business?
So, sir, basically, the console, how our console is made, basically standalone plus completed and under construction and plus coal. So there is profit from completed HAM also in the consolidated performance.
All the subsidiaries are included. It's not just the coal business, it's all the subsidiaries of the company are included in there.
Okay. And will you have that number, sir? I mean, what could be their revenue share? I mean, on quarterly basis or anything even on annual basis, will that be visible? The HAM basically, the revenue.
So on the yearly basis, the coal MDO both the MDO were around 265 crore profit, and balance is from the under construction and completed HAM and other subsidiaries.
Okay. So coal MDO 265 at a PAT level.
Sorry sir, can you come again?
No, sorry, I just missed. You mentioned 265 is what number?
Yeah, 265 crore from the coal MDO for this year.
MDO, okay. Got it. And from a revenue front, I think though in the PPT we have mentioned the total revenue which one can get from say Pachwara and that other block, and then the total coal which can be evacuated. So in terms of rupees per ton, will that be a fair number to take when we are coming to a annual sort of revenue for next year or maybe like this year?
So would you mind repeating the question again, please?
Okay, sorry. Yeah, I'll just repeat. So I think in the presentation, we have given 2-3 numbers in terms of total revenue which these mines will give us over a period of the next 10-15 odd years, and also the total coal that we can extract from these mines. So basically, on that metrics, can we just work on the realization part, and then we can come to our revenue for FY25 and 26 number. So the reason I'm asking is there any escalation which has been there, which we have built in to come to that consolidated revenue which is we have given in the PPT for the full MDO?
Sir, the total revenue, MDO business revenue that we have given in the presentation, basically it's a calculation of the total coal reserves that the company has to extract, the balance, the order book that is there, at the current prices. So we have taken it at the current pricing, like let's say the government is paying us X rupees per ton. We have done that into a direct multiplication of all the tons that we are able to extract throughout the life of the coal. So without any inflation. So this is a non-inflated number that we've done. Including inflation index, that will increase very significantly. So this is a non-inflation index number that we've kind of given, just to give you an idea of the size of the business.
Okay.
Sure. Multiplication of total reserves that we still have to extract into current price.
Okay, sure, sir. I think that's probably a bit of question from my side. Thank you.
Thank you, sir.
Thank you. We have a follow-up question from the line of Shravan Shah from Dolat Capital. Please go ahead.
Hi, sir. Sir, is it now possible that we have shared this 265 crore PAT for MDO business for FY25? Is it possible to share the revenue and EBITDA?
Shravanji, that number will be coming in our balance sheet number when the consolidated balance sheet number comes for this year, which is how that was kind of shared. Future numbers we won't be able to share at this junction. Whatever that comes in future, we will you will see in the balance sheet. So FY25 you can see right now what is there.
So I was asking on FY25, what's the MDO revenue and EBITDA in FY25?
Sir, basically I have given you the PAT number. So basically you are wanting the different EBITDA from all the subsidiary would be very difficult. So we will submit the audited account and will upload on the website. So please refer there once it is approved by the shareholders.
Okay, got it. Second, just wanted to clarification. DBL infra debt as on March is 400 crore?
Sir, it was 484 crore, and within this year, means April, we paid around 120 crore. So now balance debt is 366 crore precisely.
Okay, and we are planning to repay in this year itself.
Yes, yes. We are planning to repay entire debt of DIPL this year.
Okay. And sir, this other income of 74 odd crore in FY25, how much is the same in with dividend or distribution?
So basically, please refer our discussion in previous floor. We said the stream in which distribution is basically two-third, one-third. So one-third is basically the capital return and two-third is interest and dividend. So total around 120 crore we received. So you can say the same ratio. But the distribution we are receiving in two places, one DBL and DIPL level. So the ratio will remain same.
Okay, okay. No issues. Thank you. And all the best.
Thank you, Shravan.
Thank you. Ladies and gentlemen, this will be the last question for today, and I now hand the conference over to the management for closing comments.
Well, on behalf of everyone here at DBL, we'd like to thank all the participants who came down. And I wish a great next financial year for all of you guys. And we hope these turbulent times that we're seeing in the external environment cease soon. So hope keep your family safe, and we look forward to seeing you in the next quarter call. And if there's any more questions and concerns and doubts, please feel free to reach out to our team. Thank you.
Thank you. On behalf of Dilip Buildcon Limited, that concludes this conference. Thank you for joining us.